Good afternoon, everyone. Welcome to the January 2020 RSM VAT webinar. As usual, over the course of the next hour, this webinar will give you an update on what RSM's team regard to be the most important VAT developments in the UK and around the world over the course of the last few months. By way of introduction, my name is Phil Munn and I lead RSM's VAT team in the South region. I'm delighted to say that I'm joined today by Tom Gilbert and Sarah Halstead. Tom leads our indirect tax technology offering. Sarah is a relatively new addition to the team with the responsibility for driving VAT knowledge management across RSM's more than 60-strong VAT team. You'll have plenty of opportunities to ask questions during the course of today's presentation if you're attending our live event. But if you would like to contact Tom, Sarah, or I separately, our contact details are on this slide. We will cover a variety of topics today, focus on VAT developments in the UK and around the world. Our content will be aimed at finance professionals across a range of sectors rather than VAT specialists, albeit hopefully there will be enough topical issues to keep things interesting for VAT people too. With that in mind, we will avoid jargon and instead focus on providing our opinion on how these developments will affect your organisations and provide practical solutions that you can apply after this call. Inevitably, this means that I am obliged to say that our opinions are our own, do not reflect RSM's view. One of the advantages of logging onto our live webinar is that participants are able to ask questions during the course of today's presentation. Therefore, before we get into the meat of today's webinar, I wanted to spend a few moments explaining how those people that are attending this webinar live can ask questions. The slide in front of you should show the interface you can see as part of the webinar. Click the Q&A button at the bottom of the screen, marked by the red arrow, and simply type your question into the box highlighted. With over 400 people logging on to today's call, I'm afraid our experience suggests that we won't have an opportunity to respond to all of the questions we receive. However, we will do our very best to highlight key questions, and we will take note of the questions that we don't get a chance to address. A member of the RSM team will get back to you with our thoughts at the email address which you logged on with. For those of you that are watching this as a recording, please do contact your usual RSM contact with any questions. Right, that's enough of the logistics. Just going to go through very quickly the agenda items we want to talk to today. As always, Brexit is a feature. We will talk about the latest developments and some European legislation which has been very recently implemented in the UK as the UK remains part of the EU at the time of this recording. We'll then go on to a decision of the Upper Tribunal on News UK, and then I'll be delighted to hand over to Tom to talk a little bit about tax digitalisation. I'll make a few more comments about Melford Capital Partners, VAT recovery on activities that might be aligned to passive income. It's very much a hot topic and has been something of a feature of the courts over the last few years. Sarah will then do a VAT case law update on a few other interesting cases before turning our attention to the international stage and VAT issues more widely. We then look into the crystal ball and make our predictions for the budget, which will be scheduled for March this year. Before coming to Q&A, we will, if possible, answer any questions as they arise during the presentation. But of course, time doesn't necessarily permit us to do that, as I mentioned a moment ago. So that's the agenda. Brexit. We are nearing conclusion. On the 31st of January 2020, after a general election victory for the Conservative government, it is now inevitable that the UK will leave the EU on the 31st of January 2020. For practical purposes, for VAT and customs duty purposes at least, there will be no changes immediately. On a political level, of course, the UK will no longer be able to participate in some of the EU-level decision-making, but the VAT union, we will remain part of the single market. Those points won't change. That marks the beginning of the transition period, which is currently scheduled to run until the 31st of December 2020. And as the slide notes here, there are extensions that are possible as part of the withdrawal agreement bill, the government is seeking to close the possibility of an extension. It remains to be seen whether that withdrawal agreement will be passed in its current form, albeit at the moment, our understanding is the House of Lords only amendments do not relate to VAT or the Customs Union, and therefore we don't anticipate any extension as matters stand. Formally speaking, it's worth noting that the European Parliament must also ratify the withdrawal agreement, but that is widely regarded as being a formality rather than anything else. Given the complexity of arranging a free trade agreement with the EU before the end of the year, I think it's worthwhile making note of a couple of issues that might crop up in the event of a no-deal Brexit. First off is the Northern Ireland Protocol, which attracted a lot of attention at the end of last year. In particular, there was some uncertainty about quite how it would affect movement of goods from mainland UK into Northern Ireland, and those goods may or may not ultimately end up in the Republic of Ireland. Needless to say, there remains a great deal of uncertainty there, and it's certainly worthwhile making sure that anybody that does have a supply chain which involves Northern Ireland should pay particular attention to that protocol. The only other point that I wanted to raise as part of a no-deal Brexit planning was the fact that import VAT postponed accounting would take effect as well. A simplification measure designed to ensure that the borders remain as uncongested as possible in the event of a no-deal Brexit. Import VAT postponed accounting merely means that provided the correct documentation and information is provided to Revenue and Customs at the border, import VAT may be accounted for on a VAT return, much like acquisition tax is accounted for at the moment for those businesses that deal with intra-EU trade of goods. There are a couple of other matters that it's worth considering. Needless to say, there are a great deal of things that one should consider when it comes to Brexit, but some of the key issues that we've been advising our clients of recently, EU VAT registrations. Quite a lot of UK businesses have EU VAT registrations for one reason or another. If those VAT registrations are required but there is no establishment in the member state of registration, then it may be that the country in which you're VAT registered will require a fiscal representative once the transitional period expires. That can be relatively expensive and difficult to manage, and therefore it's certainly worth checking on those responsibilities and requirements now before we get too much closer to the end of the transition period. Second point there is about EU VAT refunds. For those businesses that are not VAT registered in the EU but do suffer EU VAT, there is a refund mechanism at the moment that is available. It will be a different mechanism once we leave the VAT union at the end of the transition period. That mechanism is considerably more time consuming and harder to use, so it's definitely worthwhile thinking about those applications and what might change after Brexit. Last but not least, the mini one-stop shop. Again, for those businesses or organisations that are affected by the mini one-stop shop and are currently registered under that scheme, it's worth looking and preparing for a change in that registration status post-Brexit, as the mini one-stop shop scheme is designed either for EU or non-EU participants, and of course our status will be changing at the end of the transition period. That's the first bit on Brexit. There was a stage last year, Jim and I conducted a VAT webinar in October when actually the general election results and indeed much of Brexit was still very, very uncertain. What did happen, what the EU knew was going to happen, is that they would be introducing the EU quick fixes from the 1st of January 2020. And of course, now that we are and will remain part of the EU for VAT purposes until the end of the year, the UK has a requirement to implement these quick fixes. The quick fixes relate to the VAT requirements associated with the movement of goods within the European Union. It may still affect UK businesses that trade in goods within the EU after Brexit, and therefore it's worth taking a note of even if it doesn't affect you at the moment. There are 4 changes here. By and large, those changes are designed to simplify or harmonise the system, or put beyond doubt some matters which the European courts have have opined on recently, and to a certain extent, we'll come on to the detail of them, to a certain extent, what the European Commission is trying to do here is to ensure that all member states apply the same rules and simplifications, perhaps most importantly, in the same manner, so that there is no double or non-taxation arising from the movement of goods within the EU. So, what are the changes? As I mentioned, there are 4 of them. The first concerns chain transactions. I think it would be fair to say that we could spend the rest of this webinar on the chain transactions changes. They are complex and difficult to describe. They cover circumstances where there is a movement of goods within the EU. So let's say there is a movement of goods from Italy to France. Now that's one movement of goods, but in some cases, with different supply chains that exist at the moment, there may be several owners of those goods through that chain. So for example, one movement of goods, Italy, France, but actually the seller sells to an intermediary that might be based in Spain. That intermediary might have a second intermediary that's based in Portugal before the customer takes ownership of those goods in their final destination. Now, the risk arising for chain transactions and the complexity is that one or more of the intermediaries in a chain transaction may be required to VAT register in a member state where they are not located. And of course, that gives rise to compliance obligations and complexity for those intermediary traders. And therefore, there have been a variety of measures over the years which have been applied by different member states in a slightly different way. And some people dialing into the call may have heard the term triangulation. Triangulation is a subset of these chain transactions. The new rules, which retain the objective of reducing the number of unnecessary VAT registrations around the EU, which state that if an intermediary is required to organise the travel from the manufacturer's location to the end customer's location, then they are the party that is entitled to treat that as an inter-community supply and therefore not charge VAT and not create some VAT registration requirements within the customer's location. Of course, if the intermediary is already VAT registered in the supplier's location, then the supplier may treat that as a domestic supply. The intermediary will acquire those goods in the country of the supplier, recover the VAT, and then treat that onward supply as an inter-community supply to the customer, who will then be entitled to recover the VAT or account for the VAT rather on using acquisition tax in exactly the usual manner. There is a requirement. This is a theme of these simplifications. There is a requirement that these transactions are properly recorded on the intermediaries' EC sales lists. Those EC sales lists at the moment are a feature of the administration concerning and recording of transactions within the EU, both for goods and for services. It's particularly important for member states to understand how those goods are moving around the EU, and therefore it is becoming more important to make sure those ECSLs for goods are accurate and complete. So the second one concerns evidence of movement of goods. Again, an area where there has been some inconsistency in the past. In the UK, we enjoy some relatively clear guidance from Revenue and Customs as to what might be provided in terms of movement of goods and that evidence. And essentially here, what member states are being encouraged to do is to ensure that that the evidence that they are able to ask taxpayers to provide to ensure that goods that have been sold have actually left that member state and the zero rating has been correctly applied. That movement of goods now has a list of very specific forms of evidence some of which you would expect, dispatch notes, airways bills, and so on and so forth. Others which may not always be available, those more traditional proof of movement are available. There are others that are out there that have been recognised by the EU, but it's worth checking on those specific requirements. Third is the requirement for a VAT registration number of the customer, and for the supplier, a requirement to ensure that your EC sales list has been completed correctly. So the European Court of Justice made it clear that while the VAT registration was a requirement, it wouldn't necessarily be a requirement to have the VAT registration prior to the sale. It was only necessary after the event, on inspection, that the VAT registration would be available to the supplier to prove that their customer was VAT registered prior to the sale, and that is one of the conditions for 0 rating. It will now be a requirement for the supplier to have the customer's VAT registration in a different member state, at the point at which a VAT invoice is raised, and as I say, a requirement to make sure that the EC sales list is correctly completed. The first part of that, the VAT registration requirement, is already in UK law and practice. The EC sales list requirement is not, and therefore it is definitely worth looking at your EC sales list completion and making sure it is up to date and accurate. It is an area where I think it would be fair to say that it can be a little bit of a hole in some people's compliance record keeping. Last but not least, call-off stocks. For those of you that are not unfamiliar with the term, call-off stock is a supplier where a supplier, let's say we have a supplier again in France, supplying into Spain for a customer, and the customer demands those goods at very, very short notice. The transit from France to Spain is too long, and therefore the French supplier will send goods to a warehouse probably located quite close to their customer, and at the point at which their customer needs particular stock, they can call on that very, very quickly. Now, in theory, in many member states, those arrangements would mean that the supplier will be required to have a VAT registration wherever that call-off stock is located. And that, again, is an unnecessary administrative burden. And while a lot of member states already provide for a call-off stock simplification, those simplifications are now a requirement of all EU member states. For UK companies, the big change really is the record-keeping requirements that those call-off stock simplifications will entail. Additional record-keeping requirements to make sure that you can use those simplifications. And in addition, again, EC sales list must be completed accurately and at the correct time, being the time at which the customer calls those stocks from the local warehouse into its own inventory. So that's the quick fixes. Next up, Brexit planning and strategy. Jim and I covered these during our last VAT webinar. By and large, these questions remain pertinent and relevant now. You know, we've got, I suppose, the addition of the Northern Ireland Protocol, which we now know could be a factor in future trading relationships, depending upon what negotiated agreement is made with the EC this year. Postponed accounting, EURI numbers. I think for my mind, the big question here is the question of contracts and whether they are properly Brexit proof. The EU quick fixes, and particularly in relation to chain transactions, require a proper understanding of who in a supply chain has responsibility for the movement of goods. And in some cases, there will be an agreed set of Incoterms which establish which party within a chain has those requirements, and when the legal title to those goods changes, at what point of the movement of those goods, the legal title changes. Those reviews for the quick fixes might be very, very helpful in terms of making sure that there is a proper understanding of the Brexit process in the round. So conducting a review, mapping out supply chains is something that we at RSM are working on quite a lot with our clients, and you know, it is proving very useful not only for the quick fixes but also for that Brexit planning more widely. I think that's all I wanted to say on Brexit. So, unless there is anything else, we will change tack entirely and talk about News UK. So, 2018, the First Tier Tribunal issued a decision on News UK, or as I should say, their full name is News Corp UK and Ireland Limited. That company is the representative member of a VAT group, which is responsible for the publication of the Times, the Sunday Times, the Sun, and the Sun on Sunday. And as many of you may know, and we may have some subscribers dialed in today, News UK made a relatively bold decision about 10 years ago to put a paywall up over the Times and the Sunday Times editions on the internet, and subscribers were required to pay a monthly, quarterly or annual fee to get access to that online content. That online content now is available on iPads and other mobile devices, as well as online. Now, the First Tier Tribunal was asked to consider whether those digital editions, those digital subscribers, should be treated for VAT purposes in the same way as the subscribers that purchase the Times and the Sunday Times as a hard copy. So the hard copy, if you go to your local newsagents, and your local newsagents will not charge VAT on the Times and the Sunday Times, that is a zero-rated newspaper. But since the inception of e-newspapers, Revenue and Customs has also been firmly of the opinion that they should be standard rated. And the reason for that, in very short terms, is that they believed that the zero rating could only be applied to goods. And e-newspapers, of course, are a supply of services. So the First Tier Tribunal was asked to consider by News UK whether Revenue and Customs' position was correct. There was also a consideration, I should say, of certain interactive apps that were available for Sun subscribers. We will concentrate on the News UK facts and circumstances as it pertains to the Times and the Sunday Times, simply because the points of distinction are relatively straightforward, and some of the points on the Sun were dismissed by the Upper Tribunal. So, on the First Tier Tribunal decision, the First Tier Tribunal had a look through the facts and circumstances, and as is usual for the First Tier Tribunal, made a finding of facts which could not be appealed. It might be sent back to the First Tier Tribunal, but that is the fact-finding court. And their finding was that the readers of those digital editions considered to be fundamentally the same as the newsprint editions. So there was a recognition that there were differences between the digital and the hard copy editions of the paper, albeit in the First Tier Tribunal's finding, at least, those differences were not sufficient to make them different, fundamentally different from the reader's point of perspective. However, the First Tier Tribunal did find in favour of Revenue and Customs. And the reason for that is that they said it could not, the UK VAT legislation, which defines a zero rating as applying to newspapers, could not be read to include e-newspapers, principally on the grounds that e-newspapers was a supply of services and newspapers was a supply of goods, and the zero rating could only be applied to the supply of goods. So a loss for News UK, perhaps not surprisingly given the amounts involved and the somewhat fundamental issues there. News UK made the decision to appeal that decision of the First Tier Tribunal. And the Upper Tribunal heard the case last year and released its decision on Christmas Eve. Lovely present for News UK, not quite so pleasant for HMRC, because the Upper Tribunal found in News UK's favour. They rejected HMRC's challenge on the First Tier Tribunal facts. HMRC had sought to suggest that First Tier Tribunal had sort of, in concluding that as far as the reader is concerned, there is fundamentally no difference between newspapers and e-newspapers. The upper tribunal said that actually it was perfectly clear that the first tier tribunal had conducted quite a thorough analysis of the facts, including a lot of witness statements, explaining what the similarities and the differences were, and in particular, how readers actually used the service that was available to them on e-newspapers and how that might compare to the newspaper readers that purchased the hard copy editions. So, having agreed with the first tier tribunal's findings, they then rejected the first tier tribunal's findings that the digital editions could not be zero rated because they are services, not goods. In other words, they said that newspapers could be read to include e-newspapers, and the fact that e-newspapers were services made no difference at all. And there was separate legislation which made it clear that the zero rating can apply to services, but I think the first tier tribunal's approach was that whilst it could be read to include zero rated services, the remainder of the zero rating for books and newspapers, magazines, periodicals suggested that that particular part of the zero rating was not supposed to include goods. Now, News UK applied what's called the always speaking doctrine to assist the upper tribunal come to this decision. And I think it would be fair to say that the always speaking doctrine, again, could fill up a separate webinar on exactly how it has been reached through different cases and the various precedents that exist. But the summary is that the always speaking doctrine looks at the legislation and interprets it in a manner which is sympathetic to the historical context. So the context here is that this zero rating has existed since the inception of VAT in the 1970s. I think at the inception of VAT, when we joined Europe for the first time, and VAT became an obligation, so we had to give up purchase tax and implement a VAT system. That zero rating has existed. I think the first personal computer was released not long after that. So as you would imagine, at the time at which newspapers was defined as being zero rated, it would be fair to say that neither the government nor the authors of that legislation would necessarily have been aware of the fact that in some 40 years later, News UK would be have digital subscribers using iPads and other things. It's worth noting that the exemptions that the UK relies upon to have the zero rating for books and newspapers was refreshed in 1991. Again, another opportunity to include e-newspapers within that definition. But in 1991, the first website was published at CERN. So again, it would not be surprising to learn that the upper tribunal considered that actually the legislators would not have anticipated e-newspapers at the moment at which they were asked to draft that legislation. So instead of looking at a strict reading of the law, the upper tribunal applied the always speaking doctrine, looked at the historical context and said actually it could include digital versions, providing those e-newspapers fulfill the legislative purpose. And the legislative purpose, which I've quoted here on the slide in front of you, to promote literacy, dissemination of knowledge, and democratic accountability by having informed public debates. But it's a very grand description of the purpose of newspapers in society. But actually, it is one that the courts found was fulfilled both by newspapers and by e-newspapers. In coming to that conclusion, there was quite a close finding of the differences that exist between newspapers and e-newspapers. So for the Times and the Sunday Times, there are different editions of those newspapers. There are usually 3 runs of the hard copy version, and those 3 runs broadly align with the digital editions. So in other words, the digital editions are updated 3 times a day. For those of you that download your Times onto a Kindle or other e-reader, it's one and done. For those of you that use the Sunday Times and the Times online, by and large, those are updated, as I say, 3 times a day. there is an ability for additions of stock press items to be added to that edition, but they're very few and far between, I think it's fair to say. There is other functionality that exists on the e-newspaper versions, so for example, video content, links to podcasts, and so on and so forth. But again, there was a finding that these are very rarely used by the subscribers of e-newspapers, and therefore actually, it doesn't make a big difference. So those functionalities were debated at some length. It is quite possible that if there had been a finding that there was a rolling news service available to e-newspapers which was not available to those that bought the print edition, then that could have made a difference, because to the extent that there is a limited number of runs, it was obvious that that could have caused the upper tribunal to say, actually, they're not quite fulfilling the same legislative purpose here. Because the upper tribunal found in favour of News UK on the grounds of the always speaking doctrine and a bare reading of that law, fiscal neutrality was not considered. It's quite possible, in fact, we regard it as almost inevitable, that this decision will be appealed by HMRC, not only because of the precedent it sets for News UK, but also of the application of this decision actually more widely in the economy. So the zero rating that is referred to here includes maps, sheet music, all sorts of periodicals and journals and magazines and so on and so forth. And a lot of those which were traditionally zero rated in print copy are now provided electronically. So the suppliers of those services should definitely consider whether those digital services which fulfill the same purpose as previous print editions might now qualify for zero rating. As I say, while this decision is likely to be appealed, unless you put a claim in now, the 4-year cap will limit the benefits available from a decision of News UK if it is ultimately decided in News UK's favour. Of course, that principally affects the suppliers, but it also affects the recipients of those services. And I'm thinking now particularly about those organisations that are not entitled to full VAT recovery. Higher education institutions, I dare say, will be purchasing a lot of digital content which may be eligible for the zero rating going forward. Sometimes those suppliers will be domestic, and therefore you might have a conversation with suppliers to say, actually, can you please protect your position because this VAT is a cost to us. In other circumstances, that might be a foreign supplier that you purchase these digital services from, and it might affect your reverse charge accounting. So there are a lot of issues there, and it's definitely worth starting these conversations now to protect your position as far as it is possible to do so with the 4-year cap. Right. I'm going to hand over now to Tom Gilbert to talk about tax digitalisation.
Thanks, Phil. So I'm going to give a MTD update, cover some of the practical points that you might be interested in. But before going into that, just linking into what Phil was saying about one of the EU quick fixes, we do offer a VAT registration number checking service. So if you do have large number of VAT registration numbers that you need to be checked, then get in touch, and that's something that we can help with. So on to making tax digital. Most of you should have either have been submitting VAT returns for a number of periods or coming up to that pretty soon. So I'm going to talk about the digital link requirements. So just to recap, most VAT registered businesses with taxable income over the VAT registration threshold have been required to keep records in digital format and submit them via the MTD API with effect from the 1st of April 2019. However, all businesses, all affected businesses are required to have full digital links between the MTD compatible software and any software that they're using from the 1st of April 2020, unless you've got the deferral from HMRC. So if you're not deferred, you need to ensure that digital links are in place literally in the next couple of months. If you are deferred, then this is something that I would still start to think about now, especially if you are a more complex business. You're using Excel, for example, and you've got lots of spreadsheets, or you've just got concerns there. And in that regard, we have been performing a lot of MTD digital link and process reviews, where we basically review the entire VAT return process in detail with a specific focus on data flow, links, and tracing numbers through Excel. And common issues that we've found include incorrectly accounted for reverse charge transactions and confusion between accounting for reverse charge and acquisition VAT as well. So if you do have any queries over digital links, need support, or would just like some further information on the review service that we offer, then please do get in touch. Further, on the digital link piece, you might have heard about a digital link extension that HMRC introduced. So in cases where businesses have got complex or legacy IT systems that may require a longer period to put in place these digital links, then businesses can apply for additional time with HMRC. However, the key point to note is that they've specifically mentioned cost alone is not a sufficient reason for this, and businesses are expected to make every effort to comply with the digital link requirement by the end of the soft landing period. However, if you did want to make an application to HMRC, the advice is to make this application, and it is a formal application, so make it as soon as possible, explaining why the digital link requirement is unachievable and not reasonable. And you also need to submit details such as information on your systems, provide a map of your systems and flows and everything. There is more information in the VAT notice. However, if you are considering this approach, then we can help you with this submission as well. And it is fair to point out that the actual criteria are fairly restrictive, although I think in practice HMRC are going down a fairly pragmatic approach with this. And the final point I wanted to note was you may have seen press coverage around submission issues with the HMRC MTD service, which did actually go down on the last submission deadline. So there have been some issues there, but HMRC's advice was, I think they gave an extra day to submit the information. We haven't seen previous issues, so I'm hoping this was a one-off. But if you do get issues, the advice is just to persevere and carry on submitting, and also don't leave it to the last minute. So in terms of MTD updates, I think that was all I was going to go through today.
Okay, thanks, Tom. Right. So one more update for me. I know Sarah's raring to get going now on some case law updates. So I'm going to have 2 minutes on Melford Capital General Partner Limited. An extremely complex set of facts here, which have been, I've tried to summarise on the right of the screen. The appellant is at the very top of the picture, MC General Partner Limited, with its owner, MC Partner LLP. Melford Capital was the general partner of an investment group that is down at the bottom of your screen there, Hyde Park Hayes Limited, which established a variety of SPVs holding investment properties, commercial investment properties. The key bit here is that the MC General Partner Limited, in green at the top there, incurred VAT on setup and operating costs and earned a priority profit share, or in VAT terms at least, this is regarded as being passive income. In other words, there is no what's called economic activity associated with the receipt of that priority profit share. However, MC General Partner Limited was VAT grouped with MC Partner LLP, with its owner, and that LLP did make supplies which were considered to be an economic activity for VAT purposes, and those were management charges plus VAT to Hyde Park Hayes Limited, which is the arrow that you can see there joining the two VAT groups. So a VAT group comprising a company that is incurring VAT on costs and receiving passive income in the form of priority profit shares. That grouped with a company that is making an economic activity. And just for completeness, I should say there was a management charge within that VAT group. That management charge was not subject to VAT by virtue of the fact those two companies are within the same VAT group. So Revenue and Customs, applying its policy, which broadly applies to holding companies, insisted that there should be a restriction on the VAT incurred by Melford Capital General Partner Limited. And that restriction applied to a proportion of the operating costs on the grounds that a proportion of that VAT can be reclaimed by reference to the management charge made by Partner LLP, but there had to be a restriction by reference to the value of the priority profit share that MC General Partner Limited received. The taxpayer, on the other hand, suggested that full VAT recovery was available, and the court found in favour of the taxpayer here and said that actually it is possible to have full VAT recovery because the VAT incurred by the VAT group related to that group's economic activity, being the activities of the group, the limited partnership, which the general partner was part of, plus the management charge, which is earned by the VAT group. So this is a very significant case, not because this is a particularly common structure, but more because it undermines Revenue and Customs policy of insisting that there should be a partial restriction of VAT on costs which can be attributable to economic and non-economic activities. And while the non-economic activity here, or the passive income, is the priority profit share, you might replace priority profit share with dividend income, and that would very closely align with Revenue and Customs policy on holding companies as it currently exists. We therefore expect an appeal by HMRC on this particular matter. Notwithstanding that, we know that this has been a topic that Revenue and Customs has been very focused on over the course of the last 5 years or so, and therefore we expect that there could be a lot of taxpayers that may wish to consider Revenue and Customs' previous policy decisions in this area and put in protective claims again on the assumption that Melford Capital is ultimately successful on appeal. So a really interesting case, that one, and one that, again, will probably run and run. So without further ado, Sarah.
Thank you, Phil. Good afternoon, everyone. It's good to be with you today. There's been a few interesting VAT decisions from the UK courts and tribunals over the last couple of months. So I'm going to run through some edited highlights of that. I'm going to start with news of a VAT dispute that concerns taxi business Uber, which we should take as a forewarning of possible VAT turmoil in store for the gig economy. To give you some background, Uber lost an appeal in 2018 against an employment tribunal ruling that found that its drivers were employees rather than self-employed contractors. That decision, which Uber has since appealed to the Supreme Court, prompted some speculation that Uber could also be liable to VAT based on the total value of the taxi service supplied to private individuals in the UK, and not just Uber's net receipts of commission. We now understand that HMRC has indeed taken the position that Uber is liable to VAT on the full value of its taxi fares, and that's subject to the Supreme Court's final ruling on the employment status appeal, which is due to be heard in July 2020. And we also understand that Uber is defending its position on that front, its position being that it's only required to account for that on its net income. We don't yet have any detail of the legal arguments that HMRC and Uber will be carrying forward into this dispute. But if Uber ultimately loses the VAT argument and has to account for VAT on the full value of taxi fares instead of just on its commissions or similar charges, the case could have implications for many other gig economy businesses with similar business models. The VAT risk isn't going to crystallise unless Uber loses its employment status case in the Supreme Court. But if it does, and then goes on to lose the VAT dispute as well, that could result in large VAT bills, both for Uber and businesses that use similar payment structures. Final ruling on this is at least a few years away, but the long-term effect of the finding against Uber could be profound. So at this stage, businesses who are operating in the gig economy should review their business models and consider taking advice on how to protect their position. Another case of interest is RSR Sports. This is a VAT appeal which asks whether children's holiday clubs are childcare with added entertainment or entertainment with a bit of added childcare. And the answer to that question determines whether VAT is payable on the fees, which is an important point for providers who are trying to meet their VAT obligations, and also for parents who are struggling to find affordable childcare during the school holidays. This isn't the first VAT tribunal to look at this question. There was another case in 2016 called Sports Academies, where the tribunal concluded that the main aim of the service was the hosting of the sporting activities and not the care and protection of children. So as a result, Sports Academy suppliers did not fall within the UK's VAT exemption for welfare services and were subject to VAT. Back in 2016, many providers took note of that case and have been accounting for VAT on their school holiday clubs where the sessions involved sport or were fun for the children to attend. But another decision that came out late last year appears to have come to a different conclusion. RSR Sports also provides regular holiday and sports camps for children. In their case, the tribunal reached the opposite conclusion to Sports Academies. RSR's services were regarded as welfare and therefore exempt from VAT. While Sports Academies and RSR were providing very similar services, there were some distinguishing factors between the two. For example, Sports Academies employed staff who were specifically trained to teach the particular activities they offered, and they used a charging structure that was based on the nature of the activities chosen. In contrast, RSR's staff held childcare qualifications, but they didn't have any particular accreditation related to the activities. This was enough to convince the court that RSR services were more concerned with the care and protection of children as opposed to the sports they played at the clubs. So we are still waiting to see if HMRC will appeal this decision to the upper tribunal. In the meantime, though, the RSR case does highlight the subtleties involved in determining the VAT liability of children's clubs and events. So we would recommend that providers review their VAT position and carefully consider how their services are advertised and whether their predominant aim is to provide the activity or the childcare. Moving on to Target Group, this is a financial services case which looks at the operation of loan accounts on behalf of the bank and whether this is an exempt supplier of financial services for VAT purposes. Target provides what it describes as loan account administration services to a UK bank, Shawbrook. The bank provides loans to customers, setting out their terms and interest rates. Target operates the loans day to day as an undisclosed agent of the bank. So essentially the loans have been outsourced to Target. HMRC concluded that Target was providing standard rated management of loan accounts subject to VAT. Target appealed, arguing that its services were exempt from VAT, either because they concerned transactions concerning payments, transfers, etc., or dealings with money, or alternatively because they were the operation of a current account. In 2018, the first tier tribunal decided the case in favour of HMRC, concluding that the supplies were subject to VAT, and the upper tribunal has now gone on and upheld that decision. In particular, the upper tribunal found that the supply was not a transaction concerning payments and transfers, so it wasn't exempt under that heading. While target service involves giving an instruction to a financial institution to make a payment, it doesn't constitute an exempt supply. Every transfer of funds made by a borrower to the bank is effected by the borrower's bank debiting their account and crediting on the other side, and target's role is limited to passing the necessary information to BACS to enable it to give the instructions to the borrower's bank and Shawbrook's bank so the transfer of funds can take place. The upper tribunals also upheld the first tier's finding that the target does not supply a current account. These findings underline the impression from an earlier European Court judgment in DPAS, which effectively restricts the application of this particular exemption to transactions that fall within the remit of a bank or similar institution. DPAS now makes it very hard for anyone other than a bank to qualify for the exemption on transactions concerning payments and transfers. Final tribunal case that I want to cover this time is impact contracting services. This is a case concerning recruitment and temporary staff, which indicates that the sector may be the latest target of missing trader fraudsters, especially those that use so-called mini umbrella companies, commonly known as MUCs, I think is the correct term. We understand that HMRC is scrutinising the VAT affairs of recruitment businesses in the supply chain that contracts with MUCs to provide temporary staff. The VAT Tribunal in Impact Contracting Services describes how HMRC has disallowed a VAT recruitment business VAT recovery of more than £40 million, alleging fraud where the MUC would charge VAT on its supply to a staff member, then disappear before paying its output back to HMRC. As this is a preliminary ruling, the full details have yet to emerge, but the case flags that HMRC could deny input tax recovery to those it believes are aware or should have been aware that their supply chain includes entities that could avoid paying VAT owed to HMRC. This development highlights the risk to the recruitment sector from inadvertently engaging MUCs that don't meet their VAT obligations and the general importance of carrying on due diligence on their supply chain. Although impact contracting is an extreme case involving fraud, the RSM VAT team has also seen other situations where HMRC is challenging the VAT treatment of supplies of staff using MUCs, including their entitlement to use the VAT flat rate scheme. So it may be worth reviewing those transactions to protect your position if you use MUCs. Moving on to some international news. Let's start with Weendal Logistic, which is a new reference to the European Court of Justice. In this case, the court has been asked to rule on the controversial question of whether EU member states may refuse to allow recovery of import VAT on goods by a business that is not the legal owner of those goods at the time they're imported. To give you some background about why this is important for UK importers, HMRC published a business brief in April 2019 announcing its views that businesses are not entitled to recover VAT paid on the import of goods that are owned by a third party. After a short transition period, that policy has been fully enforced in the UK from 15th of July 2019. This has caused problems for many businesses that import goods owned by a third party. One example is toll operators that act on behalf of pharmaceutical companies to distribute new drugs for cross-border clinical trials. HMRC's view is that non-owners may not recover import VAT on those drugs, even if the shipment appears on their monthly C79 VAT certificate. The issue is also not confined to the pharmaceutical industry. Any organisation that acts as importer but doesn't own the goods at the time of importation could be affected. This includes arrangements under which the goods are legally sold to the customer just before they're imported, but the vendor remains responsible for clearing the goods through customs and paying the duty and VAT. HMRC says the correct position is for the owner to be shown as the importer on the customs entry and recover the VAT itself. Owners that are not VAT registered in the UK may then be required to claim this VAT under the more cumbersome electronic refund directive or the 13th directive schemes. Since the new approach came into force, we understand that several importers have received assessments from HMRC to disallow recovery of import VAT in these circumstances. and also that some of these importers have appealed against these assessments on the ground that HMRC's approach is not consistent with EU law. And these disputes have also come up in other EU member states, and now a referral has come to the European Court from Slovakia, asking the court to rule on whether this restriction of the right to recover import VAT is compatible with EU law. So the reference is Wendel Logistics Services. Based on the normal timescales for such appeals to reach the judgment or opinion stage in the Court of Justice, we can expect the judgment to come out in late 2020 or early 2021. This, of course, means that because of Brexit, it's not clear whether the court's eventual ruling will be binding in the UK. Under the terms of the withdrawal agreement between the UK and the EU, the UK has broadly agreed to abide by CJU judgments that are issued before the end of the transition period. The transition period is currently scheduled to end on 31st of December 2020, but an extension can't be completely ruled out. That means it's uncertain whether the legal judgment will have been released by the time the UK leaves the jurisdiction of the EU, and whether that judgment will, as a consequence, be binding or not on the UK. So the position on this is going to remain uncertain for a while. Businesses that have recovered import VAT on goods owned by a third party should ensure that they closely monitor developments in the European Court and with Brexit. Those who have appealed against HMRC's refusal to allow them to recover import VAT should also consider asking for their appeal to be stood over pending the outcome of the Wendel case. Also on the international front, we have some developments from Hungary concerning VAT relief on bad debts, and also on real-time reporting of transactions for VAT purposes. 1st of July 2020 is going to be an important date for real-time invoice data reporting, because the Hungarian Tax Authority is planning to abolish the current reporting threshold of 100,000 Hungarian florins, which is roughly £215 based on current exchange rates. This would mean that data concerning all transactions between domestic Hungarian taxpayers would have to be reported, not just those above that threshold. The scope of taxpayers obliged to perform real-time invoice data reporting would be expanded to include those issuing invoices for transactions that are exempt from VAT and or subject to domestic reverse charge taxation. Businesses in Hungary will have 6 months to prepare for this change. The Hungarian authorities have also introduced rules to allow businesses operating in Hungary to recover VAT on bad debts for the first time. The European Court has confirmed that Hungary has been in breach of its obligations under EU VAT law in not allowing refunds of VAT accounted for when debts are unpaid. As of 1st of January 2020, suppliers have the right to reduce the taxable amount and claim a repayment of VAT on their supplies, and that's supplies that are made after 31st of December 2015 if their customers fail to pay their consideration. We understand from our Hungarian firm that the new regulations are subject to a number of strict conditions, so businesses with activities operating in Hungary should consider whether the bad debt relief claims will be cost effective for them. However, it may be possible to make claims for supplies before the 31st of December by arguing that there are directly enforceable rights under EU law to claim from an earlier period. So if you operate in Hungary, consider whether you might be affected by one or other of these developments. Finally, let's look at the budget. We now know that the next budget is going to take place on Wednesday, the 11th of March 2020. It's been over a year since the last budget, and this will also be the current Chancellor's first budget. This, combined with Brexit, makes it particularly difficult to predict what VAT changes the Chancellor may include this time. By March, we expect that the UK will have left the EU, but still be in a transition period during which it remains bound by EU VAT legislation and case law. So while it will be too soon for the Chancellor to announce immediate VAT changes that diverge from the overarching EU rules, he may use the budget to pre-announce or consult on government plans for post-Brexit VAT changes that will take effect after the transition period ends, which, as we've already discussed, is currently scheduled for 1st of January 2021. We can only guess at the possible post-Brexit changes that might be made, but there are a number of supplies that EU law currently prevents the government from applying a VAT rate lower than 5% to. Examples of which include domestic fuel and power or women's sanitary products, and both of those have been campaigns to reduce the VAT rate to 0, but the government's been unable to act due to the 5% minimum rate. The Chancellor may take the opportunity to announce the end of these unpopular taxes. RSM will, of course, be reporting on the budget, including the VAT developments, when the time comes. So I think that's it from me. Over to Phil to wind up.
Excellent. Well, according to my clock, it's 1 o'clock exactly. So thank you, Sarah, for your time today, and to Tom for your update on tax digitalisation. I appreciate both of your help. The next VAT webinar is scheduled for the 22nd of April this year. The link to register you can see there on the site. If you do want to have some updates from RSM's VAT team in the meantime, our LinkedIn VAT group can be found by searching using the term RSM's VAT group on the right of the screen there. And I think it only remains for me to show you this slide, which we do not have time to do, and this slide, which is terms and conditions. It was lovely speaking to you all today. Have a good day.